You know what's better than working for money? Getting paid just for owning stuff. You ever hear someone say they live off dividends and then immediately picture them sipping scotch on a yacht while reheating instant noodles and wondering if your boss will notice you're wearing the same pants for the third day? But here's the deal. Dividends and drips aren't just for rich people with monocles and portfolios so big. They're for you. They're for me. They're for anyone smart enough to stop lighting their paycheck on fire and start investing in assets that actually give back. Let's break it down like we're explaining it to a golden retriever that just got its first paycheck. So what the hell is a dividend? A dividend is just a cut of the profits. When you own a stock, you own a tiny piece of the company. Now, if that company makes money and doesn't blow it all on yachts or Super Bowl ads, it may pay you, the shareholder, a little thank you check. You didn't lift a finger, you didn't work overtime, you didn't answer one bullshit email marked urgent. You just held investment and boom, payout. But some companies don't pay dividends. They're in growth mode and reinvesting all profits in their business to scale up, hire people, build factories, and try to take over the world. That's not a bad thing. Amazon did it for years, Google too. Tesla's never paid a dividend in its life. These stocks grow because the company's plowing every cent into expansion. That can work, but it means you're only making money when the share price goes up and hoping other people want to buy it later. Yes, stocks that pay dividends can still grow. Johnson & Johnson, Microsoft, Apple, they've all paid dividends and grown massively over the years. You're not sacrificing growth, you're just getting paid on the side like a classy sugar baby. And this isn't some maybe you win the lottery situation. These are regular real payments, quarterly, monthly, whatever, just for owning the damn thing. It's like buying a chicken that lays golden eggs and then reinvesting those golden eggs to buy more chickens. That's where DRIPs come in. DRIP stands for Dividend Reinvestment Plan, but no one wants to say that out loud, so we just call it a DRIP. Here's how it works. Instead of pocketing that little dividend payment and blowing it on tacos or crypto or some other disaster, you use that money to automatically buy more shares. And those shares pay you more dividends, which buy more shares, which pay more dividends. And suddenly you're in a loop of financial foreplay that just bills and bills. It's compounding with a vengeance. And the beauty, you don't have to do shit. Most brokerages let you turn the drip on with one click. After that, it's just passive as hell, like your ex, except this one actually benefits you. Let's do a quick example for the nerds in the back. Say you invest in a stock that pays you a 4% annual dividend. You own $10,000 worth. That's $400 a year in dividends. Now, instead of taking that $400 and buying a PS5 or whatever people are wasting money on these days, you automatically reinvest it. So next year, you're earning dividends on $10,400. Next year, it's $10,816. It doesn't seem like much at first, but give that 20 or 30 years and it snowballs into a big fat portfolio, all from just reinvesting your crumbs. Now let's talk tax. In the US, you've got two kinds of dividends. Qualified dividends, these are the good ones, the tax advantage ones. To be qualified, the dividend has to come from a US company or an approved foreign one. And you have to have held the stock for a certain number of days, usually 60 days around the ex-dividend date. Most dividends from major companies and ETFs qualify. The tax rates on qualified dividends in 2024 numbers, it's 0% if your taxable income is up to $47,025 or $94,050 for a married couple. 15% if you're under $518,900 or $583,750 for married. 20% if you're above those. That's way lower than regular income tax. So while your salary might be taxed at 22% or 32%, your dividends might only get taxed at 15% or even zero. Free freaking money. Number two is the ordinary or the non-qualified dividends. These are taxed like regular income, more common with REITs, which is a real estate investment trust, or certain foreign stocks or funds that churn a lot. Still money, but not as sweet. In Canada, we've got something magical called the dividend tax credit. It's the government saying, thanks for investing in Canadian companies, here's a tax break. Basically, dividends from eligible Canadian corporations get grossed up. Yeah, that's the thing. And then you get a credit to offset your taxes. The results, lower effective tax rates. Let's say you earn $1,000 in eligible dividends. You'll be taxed like you earn more, but then you get a credit that wipes out most of it. Depending on your province and income, your effective tax rate could be close to 0% if your income is low to mid. Even high earners will usually pay less tax and dividends than they would on salary or interest. And if you hold dividend-paying investments inside a TFSA, it's all tax-free. No reporting, no CRA paperwork, just you, your drips, and your freedom. You could be getting paid to sit in your ass and not owe anyone a penny. And here comes the warning label. Not all dividends are created equal. Some companies pay high dividends because their stock price sucks. It's like dating someone hot who treats you like garbage. Looks good on paper, but long-term, probably a terrible decision. And here's the key factor. DRIP actually works for ETFs too. So you can reinvest the ETF dividends into buying more ETF shares, which is like buying a basket of chickens that lays eggs, which hatch into more chickens, which lay even more eggs. It's poultry-based financial domination. Now, people will tell you dividends are old school. That growth stocks like Tesla or some AI crypto unicorn will make you rich faster. Maybe. But those don't pay you to wait. Dividends do. They're income in your pocket, or better yet, more shares in your portfolio while the market does its thing. When everyone else is panic selling in a downturn, you're still getting paid. Even when prices are down, dividends are still dropping into your account like clockwork. That's power. That's peace of mind. That's not having to panic if your boss turns into a dickhead because your investments are paying you rent. So to sum it up, like we're shouting outside a pub table, buy solid ETFs to pay dividends. Turn on your drip, hold them in a tax advantage account if you can, reinvest everything, and in 10 to 20 years, you'll be swimming in golden eggs while everyone else is bitching about inflation and paying $8 for a sad sandwich. Dividends aren't sexy, they don't double overnight, they're not going to win you bragging rights at the office, but they work quietly, steadily, relentlessly. And one day they might be your ticket to not needing a job, a boss, or pants. Free money, baby. Why is this better than day trading or buying speculative tech stocks? Because you don't have to check the charts every day. You don't have to pretend you're a Wall Street genius. You just buy a good dividend ETFs, reinvest, and let it do its thing. Let time do its thing. If you're 25 and start with even $100 a month into a dividend ETF, reinvesting all the dividends, by the time you're 45 or 50, you're staring down real passive income. At that point, you're not saving for retirement. You're already retired. You just haven't told your boss yet. That's how the smart money plays the long game. You like this? Subscribe for more. Hit like and subscribe. Go on. You know you want to do it. You want to learn more, but you're just lazy. Fucking hit it.